Hey, everybody, welcome to another episode of the Under the Hood podcast. This is your co host, Tim Douglas, and this podcast is sponsored by Stallion Capital. And today on the show, we have Colin Overweg, who is the founder and CEO of Advize Wealth. Colin, how are you doing?
Doing great, Tim. Thanks for having me.
Of course. Thanks for coming on. And we always like to jump right into the show with just hearing a bit more about you, your financial journey, and your firm. So if you could jump in, that'd be great.
Yeah, so started out going to Michigan State University and stumbling around with a few different firms, worked at a couple large broker dealers, and knew I wanted to be in financial planning, of course, by this point. And what I didn't love about the model that I was working within is that, as you know, a lot of large custodians manufacture their own products. And every plan that we did ended up with a similar product, regardless of how we got there. And I didn't want to be kind of cuffed to the technology that we were told to use, the products we were told to use, how we were supposed to charge. So after kind of sharpening my teeth in the industry, I bounced around to two different firms and said, you know what, I'm just going to do this on my own. So started Advize Wealth Management in 2018 and really have just been hitting the ground running ever since, bringing on clients, some in the retirement arena that I'm sure we'll get into, some of my own demographics, so a little bit younger, and really being able to serve them in a way that I see fit, and of course the clients are resonating well with. So happy to expand on any one of those very general topics there.
No, for sure, man. I appreciate the overview. And I always like to hear a bit more. So we've had that kind of story where people are at a broker dealer, they have to sell this kind of classic product, they have to push this product that they don't have a kind of 100% conviction in, right? So then they go the independent route, and now they can create more custom plans for their clients. But when they're creating those custom plans, the information sourcing is always something I like to get into. So, how are you staying up to date with the latest market trends and financial strategies so that you can take the best information to clients to ensure their portfolio is optimized for their goals?
Such a great question. And I do get that every now and again because I own my own RIA. I'm a solo advisor. So I'm working one on one with my clients. There's no team members, there's no large broker dealer kind of navigating or overseeing the work that I'm doing. Now, of course, I'm still registered with SEC FINRA as any other large firm. It's just that I don't have thousands of employees like JP Morgan or Goldman Sachs, but we're still talking and registering with the same regulatory body. So with that being said, where do you get information, right? Are these just Colin's ideas? And it kind of depends. I work with a couple large financial institutions. Of course, clients are not just sending their money over to my bank account. I highly recommend you do not do that if any advisor tells you to, or any financial quote unquote professional. So I'm using custodians, the large ones being, TD Ameritrade and Schwab as they just merged. Another popular and fun one that I really enjoy working with is Betterment for advisors, or Betterment is just the B2B and the B2C options that they also have. That's a robo platform. We might double click on that later in the conversation. And these large custodians have just a wealth of information. They're really trying to serve their advisors. So I'm their customer. They're allowing me to gain access to a lot of their investment and different type of research. So being able to tap into these massive, massive institutions with literally trillions with a T of assets under management, and then being able to use that information from a broad scope and then tailor it to my specific client needs is a really, really cool kind of win in both camps. In my opinion, you're getting access to large institution information, but then you're getting that individual tailored touch from a boutique wealth management firm. So that's really kind of how I position myself with my clients.
I love it. I love it. Yeah. The custodians providing that information makes a ton of sense. Do you ever find that there are gaps in the institutional knowledge where you have to go to other sources to fill those gaps, either live news, or I've heard some people mention Reddit or Twitter, or there are plenty of places to go to get information?
Heck yeah, man. I mean, there's going to be gaps in any body of information, right? I mean, it's unknown and unknowable to get all of the information. So you really do have to lean into your curiosities and find your heroes in this space, whether you're going to find them on Reddit, Twitter, etc. So I definitely subscribe to my fair share of Substacks and other authors and bloggers. And I'm always listening to podcasts. I love participating in podcasts. Audio has become such a wealth of information. Every time I go for a walk, I'm jamming out to some new investment management podcast. So yours is going to be one of them for sure. And it's amazing when you just kind of get that huge collection of information, and again try to just distill it down to what's important to you, what's important to your clients, and how do we apply that information.
Yeah, no, absolutely. And speaking of applying that information, I do want to jump into current market insights. So tell us about the kind of factors that you feel are most important to pay attention to in today's market. And then what's your high level strategy to address those factors in client portfolios?
So much to dissect there. Where I usually start when I'm talking with clients, though, is we got to understand what is the purpose with these dollars, right? And then we're going to kind of be able to get into more market specific stuff. So the really, really simple, broad, I actually call it the stair steps. Kind of your first stair step is going to be that maybe 2 year time horizon. When do you need the money? If you need a down payment in the next couple of years, that's really going on the first stair step, your emergency fund. Then you have the second stair step. It's a very difficult stair step to invest in. That's usually like the 3 to 10 year time horizon. And then I call it the third stair step is the 10 year plus. And this is where you can really kind of put your pedal to the metal and try to go demand as much return as you can on your capital. So zipping back down to the first stair step, high yield savings. I mean, for the first time in a long time, cash is actually yielding something and it's a real return above and beyond inflation. So this is a really unique environment where clients are actually able to be rewarded for being a saver and being relatively conservative. So that is a bucket that has become so popular. I'm sure you're hearing it even from your clients and from other advisors that the high yield savings account is sexy again. Like people are bragging about getting 4 or 5.5% on their cash with taking no market risk, which is really, really cool. Then you kind of start moving up the stair step, and then we start getting into actually probably more of your style of investing, getting those, base hits. We're not going for home runs, just really steady returns, trying to find something reasonably fixed, maybe in that 5 to 7, 6% range. And then, of course, the third stair step. And once we get there, then I'm usually referring to equities, stock market, and from there, starting to put together a portfolio that makes sense for a client. So to get more, double click on the third stair step there, I believe markets are relatively efficient. It's really, really difficult to be able to buy and sell individual stocks and get fantastic, maybe even above market performance long term. That information, again, in my opinion, is unknown and unknowable. And even if you are trading on information that is unknown, that's illegal. It's insider trading. So, really, what my job is, in my opinion, is to help my clients get market performance. And whether that be S&P 500 index fund, whether that be the small cap index, whether it's a mid cap index, international, emerging market, we're going to put together a beautiful portfolio that represents all of those different markets and then do our best to continue to rebalance, tax loss harvest, manage the portfolio appropriately, be reinvesting our dividends when appropriate, maybe putting some of the dividend yielding stock in qualified accounts so you're not paying 1099 dividends on all of this income every single year, and just trying to be as efficient as we possibly can and being a great fiduciary to the client.
Yeah, no, absolutely. And so I noticed you talked about the index in the various markets. Do you construct portfolios that way to address anything specific in today's market, or is diversification just kind of a general rule of thumb in how you're constructing portfolios?
Such a good question. And there's a little bit of, factor tilt into value investing just based on market research and evidence based investing, that value tends to outperform long term. And I do have a small factor tilt towards small cap. So, once again, history tells us that small companies tend to outperform big companies, although that hasn't been necessarily the case with our Magnificent Seven and you name it. So I do have some tilts into maybe a little bit above and beyond just purely market cap weighted, like what you'd find in an S&P 500 fund, where Apple and Microsoft, largest companies, are going to be the largest representatives of the portfolio. But that is, for the most part, how it's invested. Now, do I have maybe a few hunches and things like that? Like, I'll have clients, and that's actually more or less the fourth stair step. And I usually don't even get into the fourth stair step, but I call that more speculation. If you're trying to go out and make individual bets, I feel like you are starting to get into a speculative camp. You're not just simply investing based on market weighted averages and how large companies are. So I really don't get too far into that camp. I just don't feel it's I have the ability to make guesses and make bets. Now, with that being said, do I own some Bitcoin and do I have a couple individual stocks? Yes, I have probably 90% of my portfolio and my low cost, globally diversified index fund models that have a few factor tilts. And then the 10%, 5 to 10% is kind of the cherry on top, where maybe I'm okay with making a couple individual bets. And clients sometimes want to have some exposure to their employee stock purchase plan. So maybe they want to own their company stock, or maybe they have an incentive stock option, and they want to be able to gain some exposure and maybe hope that their private holding is going to IPO or something like that. So we'll absolutely take that into consideration and say, okay, maybe we do want to make a couple individual bets, but our ability to make work become optional, retire on time, send our kids to school is going to be comprised of that low cost, globally diversified portfolio.
Yeah, absolutely. And I guess the whole kind of theme behind that portfolio, and correct me if I'm wrong, but when stuff like the interest rate hikes or international issues that may affect markets come into play, that portfolio is constructed such that those goals don't come into the risk zone,
Mhm.
if you will. Like our goals are going to be by and large safe with how we're constructing our portfolio outside of any crazy black swan event that nobody can see.
Yeah, it's true. I mean, nobody saw COVID coming. Nobody saw Ukraine war coming.
Yeah.
Like, there has just been so many what feel like, I've never even heard the word unprecedented so much, I feel like, until the last 5 years. And it's true though. And if you look into history even more, like, we have gone through world wars and president assassinations and famines and hyperinflation and so many different what feels like game changing, world ending, portfolio manipulating, however we wish to say it, like so many events that you would think you should just completely go back to the drawing board. And I think sometimes it's actually almost a zig when everyone's zagging, or a zag when everyone's zigging, is just to stay in your lane and to stay diversified and maybe do some rebalancing here and there. But I mean, Warren Buffett said it best, that the stock market is a device for transferring money from the inpatient to the patient. And I'm really trying. Half of my job, I think, is to be a cheerleader and to be a therapist for my clients and making sure that we don't make any major mistakes.
I love it. Well, cool. The next question we typically ask about is risk. And so we've touched on it a little bit with diversification, but is there anything you want to add to the conversation of risk given the current state of the market?
I think risk is an interesting topic. I mean, I always am still trying to wrap my mind around it and finding better ways to explain it with clients. But one area I often see that is even in like individual real estate investing, and I'm always trying to make the comparison of risk versus volatility. I feel like a lot of people will say, "My goodness, the stock market is so choppy, it's so risky." But what's interesting, in my opinion, is that risk is really more of the chances of a bad outcome, in my opinion, long term, because our goal is to never run out of money in retirement for most of my clients. And so that's kind of the long term deal here. So, when is there any risk of loss of principal in these portfolios? And the answer is kind of no. If you are globally diversified in low cost index funds, you are literally owning thousands of the world's greatest companies, and even if Adidas goes under, Nike's going to buy them, or if vice versa. And if one gas company goes under, the other one's going to somehow benefit, and you own all of them. So there's the chances that every one of these companies go under at the same time. Well, now you're talking about a more of a dystopian scenario here that maybe you're going to hedge with guns, food, and water. So that's kind of outside of the scope of the portfolio here. So as far as risk goes, I think trying to explain that with clients that just because your portfolio went from 100,000 to 70,000, that doesn't mean it's going to stay there. And history has told us it never, ever has long term. So trying to get clients into a portfolio that matches their time horizon with investing is extremely, extremely important. Now, starting to compare that to maybe like an individual duplex or an individual single family home. Now, you could have really juicy returns in real estate, especially when it's leveraged and you're talking cash on cash returns. But there are mom and pop investors out there who had a tenant who didn't pay, they couldn't make the mortgage payments, and ended up having to foreclose on the property and lost their principal. They actually lost their money. Now, that just doesn't fundamentally happen. No one's going to come knocking on your door for the 401k and say, "Hey, your S&P 500 is down," unless you're taking margin or anything, but assuming you're not, no one's going to come foreclose on your 401k. That just doesn't happen. So the risk profiles are just so fundamentally different. That's when we start talking about, all right, does the return start to match the type of risk? And actually, I had a great conversation with you and Vincent yesterday talking about returns and how you guys are diversified in your own type of portfolios. But hopefully that kind of gave at least a little uh, idea of how I think about risk.
No, that makes a lot of sense. And I like the mom and pop real estate investor example because you'll have somebody get into one or two rentals in an effort to have like that kind of $1 million property completely paid off 30 years from now. But so much can happen in 30 years. And if you're not full time in the real estate game, like it really is a business. And so now you're looking at more of a not an investment that's going to be completely passive and something you don't have to worry about. And it's just going to grow without your input with relatively low risk. But it's like, if I'm going to make this thing grow, I need to be focusing on what competitive advantages I have in the marketplace. And that is, like you said, just a completely different risk profile. How a business owner looks at risk and then how an investor looks at risk, especially when they're starting out, two very, very different things. And so it's very important that you're assessing risk properly in your life on the proper timeline with the right context of what you're actually trying to do.
You nailed it, man. And it actually brings up even another point that you kind of touched on is that if you're running that business and you're operating it, and people will talk about retirement and wanting to retire with real estate and being their own boss there and managing their properties, is that really retirement? Meaning that you're not doing anything. Like you're still a property manager. Like that is now your new job. And again, are you actually diversified if you have one home in one property within one state with one tenant? There's a few additional things to probably consider when taking that project on.
Exactly. And like you mentioned, at Stallion, we're like diversify in our own way because we have a portfolio of, 90 to 100 loans at any given time. And if you intend on picking up 90 to 100 rentals and running that as your full time business, then yeah, start stacking up the one home, the two home, the three home, and build towards that. But if that's not your goal, you have to ask yourself, is that a necessary level of risk to get to my goal? And it probably won't be for the majority of people, if we're being honest.
And even within that diversified portfolio, you still need to be a successful company. I mean, I know, could you guys just walk away and everything just continues to manage itself? Probably not. So there's a lot of moving parts in making this thing work.
Yeah, no, absolutely. Well, we talked a little bit about portfolio construction from the step perspective, right? Can you recap the steps for us?
Yeah, so very simple. It's based on time horizons. First stair step is usually that 1 to 2 year range. Second stair step is maybe 3 to 10 years, and then your third stair step is 10-year plus. And if you want to get into the fourth stair step, we talk about speculative bets, maybe your Bitcoin or individual stocks, etc. But usually, I'm focusing on 1 through 3 and just trying to figure out, okay, is this going to be cash? Is this going to be bonds or some type of fixed instrument? Or is this going to be equities?
Yeah, and so it's pretty much that cash or fixed instrument that's pretty immediately liquid is that 1 to 3, 1 to maybe 4 to 5 years if you're maybe trying to buy a house, and then equities is everything else, is kind of how you construct that portfolio.
Yeah, for the most part. And of course, I'm overgeneralizing here because there's individual holdings on every level, and having those conversations with clients is the key there. But what just like brings a tear to my eye is when a client will call me up and say, "Hey, I have extra money. I want to put it on the third stair step." Like right away, we're already speaking the same language. And what they just told me is that I don't need to touch this money for 10 years plus, and I'm okay if it goes down 10, 20, 30% on a given day. I'm not going to freak out. We can allow this to continue compounding. We know that volatility is a fee that we're happy to pay in order to get great long term performance.
Yeah, no, absolutely. And speaking of that, the volatility, the kind of longer lockup period, I do want to jump to alts now.
Yes.
And so when you're thinking about alternatives in today's market, how are you thinking about them? How are you evaluating them? Just kind of talk to us about that.
Yeah, so honestly, before meeting you guys, my knee jerk reaction to alts was more in that fourth stair step camp, that speculative camp. The let's go out and buy some private holding. Maybe it's a private company that is hoping to IPO someday. That's probably the most common one I see amongst my younger, high income earning clients. And then the next one might be like trying to go out and find a VC fund or a PE fund that has a lockup period of 5, 7 years, or maybe even infinite until some type of liquidity event. And kind of try the goal there is, of course, big performance, trying to hit a home run. Maybe you can get the 10 bagger, as they say, and 10x your money. That's kind of what my thought on alternatives has been, for the most part. Obviously, you have opened my eyes, and even more as I've learned about them is that actually alternatives can be relatively safe. Maybe they could actually even belong on the second or third stair step, or maybe even the first stair step. So that's been really interesting to learn and get educated on.
Yeah, no, absolutely. And we had an advisor come on towards the beginning of the show, like our first couple episodes, and he was talking about how alternatives can be a real scary word, but when you break it down, there's only two ways that an investment can kind of sit on a balance sheet. It's either debt or equity, and people understand both of those things, right? So whether you're, buying equity in a company or participating in real estate loans that are 6 to 18 months long, right? It's you probably understand the investment when you break it down from an investment perspective. And so I do think it's interesting though that you're having clients that want to, check out that company that's going to IPO. Where do you find opportunities like that? That's actually, I've had many of these podcasts, and it's the first time I've heard about that particular investment.
Yeah, so I mean, getting your hands on private holdings is tough. And usually that opportunity is most easily accessible by its employees. So a lot of times there will be some type of equity grant given to an employee. So, they receive their W-2 salary, they maybe receive the quarterly or annual bonus, and then they have the equity grant. Now, if it's a publicly traded company, a lot of times it's referred to as an RSU, a restricted stock unit, and you could simply receive that stock. You could do nothing, aka, and just hold it in the brokerage account that it's given to you on. You could sell it immediately and go buy a car. You receive the cash or put it in your bank account, whatever, reinvest it in a diversified account is what I'd hope you do. And then for the private holdings, though, what do? You have this equity. It's sitting on the balance sheet. It's sitting at the custodian, but you really can't sell it. There's no buyers out there. You can't just go to the stock exchange and trade stock for cash. And that's the beautiful thing about the capitalistic market that we've built around ourselves as in the stock market is liquidity with stock. And the private holdings really don't have that benefit. So what do? In a lot of cases, you're kind of waiting and hoping for a liquidity event. Sometimes it's internal, where the company will offer you to sell some of the stock in exchange for cash. But in a lot of cases, you are waiting for an IPO, initial public offering event. And that's really, really exciting. There's a lot of tax strategy to be done around that. And I've been fortunate enough to sit front row through a few of those events with my clients. And it's really, really exciting. Sometimes it can be a life changing sum of money when someone goes from a holding that was maybe worth $1 or $2, and now all of a sudden it IPOs at $40. And I mean, that is just a unbelievable type of multiplier that you're receiving on that equity and being able to cash it out.
Yeah, no, absolutely. A 40x or a 20x return is insane.
Yeah, it's pretty unheard of, and maybe I'm being a little exaggerating there, but I mean, coming out here, for example, I have a client in Reddit. Obviously, not going to use any names here, but that's a big deal. Reddit's IPOing just recently. Right now, my client is still in the lockup period where they're unable to liquidate all of their holdings, but that was a life changing sum of money, and they've worked there for almost a decade, and those shares just sat on the balance sheet, just hoping and praying and crossing your fingers that someday that number on the screen is actually going to materialize and be a number in your bank account.
That's an insane period of time to wait and like hope that it actually works out.
Yeah.
Like it really is. There's some entrepreneurial stuff there of like, I'm really in it with this business. Like my stock is literally here.
Yeah.
So yeah, that's exciting that you got to sit through that experience with some
And I
clients.
think that's true with even a lot of business owners that don't really think about the equity value of their company. And even like my little company with myself as the only employee, like there is some equity value in the business and the clients that I have that I'm working with. And it's really interesting to see that. It's definitely something I've been a little bit more exposed to in just thoughts of growth and buying practices or buying companies, and trying to grow via small acquisitions for my for relative size here. But it's still really, really interesting and something people don't a lot of times put a lot of thought into.
Absolutely. Yeah. You're going to get me off the markets and on to buying businesses. No, absolutely. Well, I do want to talk a little bit more about any alternatives that you are looking to learn more about in 2024.
Well, recent conversations with you and Vincent have been fantastic. So, definitely got to give a quick plug to Stallion here, of course. That's probably one that is maybe the more easy one to implement, especially on the more second stair step level, where it's something that is going to be going for base hits and and doubles here, not trying to hit home runs, and also having access to a pretty steady stream of income and also liquidity on a quarterly basis, from what I understand. So, definitely one that I'm thinking of there. And then the other one is probably just still kind of understanding the speculative world. And a lot of people want to talk about the sexy VC and PE firms. So trying to understand, how do you invest in Starlink of Elon Musk's company, before that thing IPOs, and getting your hands on some shares there. So those are things that are fun to learn about. I don't know if it's necessarily worth putting a ton of time and effort into, given that PE and VC returns, especially if you're not in like the top decile of performers, really doesn't have a great track record compared to even just low cost index funds. So sometimes it's a little bit of a shinier object than what it's actually worth. But being able to at least speak intelligently to it and feel that you've explored and looked under every rock on behalf of your clients is important. So probably a little bit of a broad scope there, ranging from the second stair step all the way up to the fourth.
Yeah, no, absolutely. I love it. Well, now we are going to jump into the final section of the show where we just want to hear more about you and your firm and how you deal with clients. So, talk to us a little bit more about how people can really tell your firm apart from other firms with financial advisors.
Yeah, I'd say probably one of the, at least what used to be unique, maybe it's becoming less unique, is that my firm is 100% virtual. So I have clients from around the country. And my joke is that I want to take every client out for dinner. I want to take you out for coffee or grab some drinks or something. But when we meet in person, we're having fun and we save the work for Zoom. And that has been a really, really great way to build a practice. Number one, in a successful business, staying low cost. And really, it's helping me become more competitive because I brag about being able to give a lot of those, pass on a lot of that lower cost to my clients. So I can do that in the form of a lower asset management fee in many cases. And that's a really great piece of the business. Now, the second thing that's reasonably unique with my practice is that I'm a lot of times more focused on high income earners that don't have a ton of investable assets today. I know a lot of firms are going after the retirees that maybe already have accumulated substantial wealth. And just given my younger demographic, it seems to attract younger clients as well. That's a really fun space. So working with people in their 30s, 40s, and sometimes even 50s who are just having kids, they're getting married, they're buying businesses, they're changing jobs. There's so much additional planning around those type of life-changing moments above and beyond just the portfolio. So sometimes the portfolio ends up only being maybe 10% of what we talk about because there's so much additional planning around those life-changing events. And then I'd say the last one that's maybe unique just to myself is the representation, the digital footprint that I have on social media. It's I like to wear my heart on my sleeve and just talk about the things that I enjoy. And I'm not showing up to my meetings usually much more dressed than what you see now. I mean, I'm rocking a golf polo because I got tea time later on today, and I love talking about that. And my clients love hearing about how bad my slice is, and they love hearing about the poor surfing attempts that I make and the boating and my family. And in the newsletter, I'm always sending pictures of my daughter. And I swear that's the only reason people follow the newsletter. And it's really fun. It's much more of a family environment. I have the rule: no assholes allowed, right? So we're here to
Yeah.
have a good time, and if that's not you, that's cool. My firm is only so big; I can only serve so many clients. So we're going to make sure that we have a good time, and I think clients really know that I'm there for them. Like I will ride or die with my clients, and they can feel that year after year.
So you mentioned being ride or die with your clients, the kind of community, the relationship there. What do you think is most important to that ideal client advisor relationship?
People want to know that you care. That is, I can't stress it enough, especially to younger advisors out there who are maybe trying to get into this business and you want to flex on how much information you know and how smart you are. And that's great. But honestly, just using layman's terms, asking difficult questions respectfully, and being able to repeat back to clients what they told you and making sure that you understand their concerns and understand their goals, that is really what it's about. And clients are just going to lean so much more into that. They're going to share more. They're going to trust you more. They're going to implement your advice more if you are able to really articulate back to them what they feel they're trying to articulate to you. And that's can't stress that importance enough.
Yeah. No, absolutely. I love it. Well, awesome, Colin. If people are listening to this and they want to know more about you, where should they go to find out more?
Yeah, hit me up. Everyone who's listening, I promise I'll reach back out. I'm a nice dude most of the time. You can find me on virtually any social media platform. I mean, TikTok, oddly enough, is probably my largest and maybe the most engaging. I'm on Instagram, YouTube, Twitter, or now X, LinkedIn. You can find me on all of them. I'm a lot of times repurposing my content intentionally across many of those platforms. And of course, on the website, you can subscribe to the newsletter. So at Advize with a Z, advisewealth.com.
There we go. All the links to do so will be down in the show notes. And Colin, thanks for coming on the show.
Thanks for having me, Tim. A lot of fun.
Of course. Thank you guys for watching, and we will see everybody on the next one.